Well, welcome to Agents Confidential. I'm Yana, and we have Brian as a guest interviewer today. And we are going to be chatting with Andrew Saul. So we are so happy that you decided to come on with us today. And Brian, let's just get into it.
So, Andrew, for listeners that aren't familiar with you, which are probably living under a rock, you're pretty active on social media and everything. Tell us a little bit about your role at Physicians Mutual and what it is you do to help agents on a daily basis.
Yeah, good question, Brian. So I'm a regional sales director here with Physicians Mutual. My days are spent quite literally serving agents. So somewhere over 10,000 agents I'm responsible for, and most of them have my cell phone number, or at least it appears they have my cell phone number. And I get text messages, phone calls, and emails all day, every day, helping agents primarily in the Medicare sphere. I mean, I still get some questions outside of Medicare with under 65 and ancillary products, but primarily in the Medicare sphere. And bro, I love it. I love it. I don't know how else to say
You
it.
do
I
such
love
a
it.
good job, man. All of our agents that are working with Physicians Mutual always comment on how attentive you are. I don't know how you do it with 10,000 agents. That seems unmanageable, but you have a superpower that obviously we don't have.
Well, we know
That's
that nobody really grows up wanting to be in insurance, but how
facts.
did you get here? What did your journey look like before Physicians Mutual?
Yeah, and to be fair, my kid may grow up wanting this because my wife and I both do this, and he sees it in and out every single day. She retired from it, but when she wasn't. So he may actually be the only kid I've ever met who's like, I want to be an insurance agent when I grow up. I got into it. I was a youth pastor making like nothing. I don't know very many jobs that are as underpaid as that job. I was making
Yeah.
$350 a month full time, so I was getting my butt kicked. I don't even think that's
Wow.
minimum wage, but it is what it is. Anyways, so my wife was working collections and for a car lot, and it was tough. So it was her fifth year doing it, and she said, "Man, I am tired of calling people and telling them don't buy your kid any Christmas presents, pay your car note instead." So she said, "I'm done doing this." So she put in her 2 weeks notice. She went into Savannah, Georgia, and we were out. She was preaching this something out there in Savannah, Georgia, and this lady happened to be there listening to my wife preach, and she is in Medicare. Actually, she works for Physicians Mutual. Living in Alabama, she was in Savannah for this meeting. Talked to my wife, said, "Hey, I think you would be great. I'm looking for someone for a job. I think you'd be great at this." And my wife came back and told me about it. And I thought to myself, oh, this sounds like an MLM. This sounds a whole lot like Advocare or Amway or something like that. I think I
That's
want to hear
exactly what
about
I
this.
thought when I
So,
got in the business too. That's
come on,
hilarious.
bro. I'm telling you, that was my fear. That was my fear. So I went and met with this lady. Her name's Trina Gilbert. Me and Ellie both went and met with her. Take out a piece of paper and write down 10 people you know who need life insurance and then go cold call them. No, I'm not playing that game. Just,
We're only
anyways,
laughing because
anyways, this
everybody
was
is
it.
probably.
Exactly, bro. Exactly. So she ended up coming on board. Her first month, she made like 2 grand, and we were like, "Oh, we can't live off this," because I wasn't earning the income yet. Her second month was the same thing, bro. Her third month, it's like all of heaven answered. She got a check for $23,000 because she was doing Medigap and annuity. And when that hit, we said, "This is the answer from heaven. This is absolutely what
Oh,
we
yeah.
want to do." So she did a year in it, and then I decided to come on, and it's all just history from there.
Wife, does she work for Physicians Mutual as well?
No, no, she independent broker, and I actually started an
Okay.
independent broker. She would do MA and Part D, and I would do Medigap, and it's just kind of we tag teamed like that. The problem was the Physicians Mutual has this patented plan called the Innovative G, and everyone I ran into for a Medigap almost exclusively, the Innovative G made the most sense. So at that point, I was like, man, if I can't beat them, maybe I should join them. So I ended up talking to Trina about coming on board as a W 2. Took a job as an assistant manager. This was back in 2016 ish, something in there, and loved it. I really enjoyed teaching, training, and going out on appointments with agents and writing policies with them. and then bringing agents on my appointment so they could see how to write policies. And in 2020, I had been like the number one manager for 2 or 3 years in a row. And in 2020, I got a call from Trina's boss. His name's Hank. He asked me if I would be willing to take a position as a sales director, essentially, but in Fort Worth, Texas. And I was like, I don't know, let me think about it. Yes. So we flew out here. In the next week, I flew out. The day after I flew out, I bought a house and then flew back. I make decisions real quick. I'm that person. And then flew back, packed up my family. I moved down the next week. They moved down the week after that. And bro, it's just been running from here. So last May, I took a role as a regional sales director and just super happy with it. Very thankful to be where we are. Very grateful and thankful.
That's awesome, man. And so when you started with Physicians Mutual, was that back before the independent agent model existed where it was essentially all captive?
Yeah, yes. That's why I did Medigap. She did MedSup too, but primarily she was MA and Part D. I was Medigap, though their model shifted in a little earlier in 2019, but 2019 to bringing on independent brokers. And then it shifted to bringing on agencies. And now we got wonderful people like you who are top line agencies who can bring on downlines. So yeah, that shift happened a little bit before 2020. So when I was an assistant manager, sure did. And it was a good shift.
It's wild. I was out with an agent a couple weeks ago for lunch, and they were asking about what our recommendations were for individual dental plans. And of course, we brought up Physicians Mutual. Just as soon as I said that, the TV lit up with the Physicians Mutual commercial. You couldn't have timed it better. It was amazing. That sucker is going 24/7. I mean, you guys got to be throwing some big bucks into that right now.
But yeah, we're doing a lot of dental. We're doing 1,500 to 2,000 of our dental every business day. I mean, we are kicking butt and taking names. Yeah, it's a strong.
Really love you guys' dental product. The no annual maximum on there is almost too good to be true. But it's quickly become one of our go-tos for most of our agents. You had just spoke about the Innovative G plan. That was a question I was going to bring up with you. Obviously, you guys are known for the Innovative G, and that is a proprietary product, I believe, to you over at Physicians Mutual.
Right.
For our listeners that aren't familiar with that, could you just give us a high-level view of how that's different from a regular G and maybe where agents could position that?
Yeah, and we're about to launch Innovative G in a whole lot more states. So the Innovative G is a patented Medicare supplement. And now when I say patented, I don't mean that we created like a new letter in the alphabet. So you got Medigap plans A through N. So it's not like we came out with Medicare supplement plan Q, plan S, plan T, plan R. It's still a plan G, but it's a plan G that has a rider. The way the rider works is this. It adds a high deductible to a traditional plan G. So you have a high deductible G, right? You guys familiar with a high deductible G? So essentially it adds that same deductible to a traditional plan G. But the deductible disappears once you've been on the plan 3 calendar years. So let's say you wrote an Innovative G for 5/1 effective. So it's to start 5/1 this year. Well, your first calendar year's up by the time 1/1/27 comes around. So you've been on the plan 7 months, your first calendar year's up. Then you have all of 2027, all of 2028. So that's 2 years and 7 months if you started 5/1, right? January 1st of 2029, that deductible falls off. And you keep what's known as the Innovative Premium Discount Rider for life. So when you're comparing our Innovative to a traditional G, our traditional G, the discount's somewhere between 20 to 40% depending on your state and your age, right? So you keep that discounted premium for life. Now pause. You will have rate increases. Inflation increases are going to come. If you're on a attained age policy, age premiums will come. But you have a rider that gives you a discount from our regular G forever. Now, here's the beauty of the plan. At any point, whether you get cold feet or a bad diagnosis, we give you the guaranteed issue right if you choose to drop that rider, drop that high deductible, and we will move you to a traditional Plan G's benefits, guaranteed issue, no underwriting, which essentially means we let you try the plan before you fully commit to it. Here's the deal. If you stick with the Innovative G, and listen to me when I say this, you have the healthiest block of Plan G business for the rest of your life. And if it's the healthiest block, theoretically then it should be the most stable block of any Plan G in the nation. Because it's a Plan G, it just has that rider. The reason I'm telling you it's the healthiest block of Plan G business is because sick people don't take it. Name me someone with a cancer diagnosis who takes a high deductible. What about major diabetes, dialysis, organ transplant, stem cell transplant, ESRD, ALS, Ebola virus victim? I mean, you get what I'm saying. They don't take high deductible Gs. They take a Plan N or Plan G, which skews the morbidity on that block of business for that carrier. The Innovative G, it's the healthiest block of regular Plan G business of any carrier in the nation because sick people don't take it. Because of that, it carries more stability than any traditional Plan G in the nation. And that's the value members have with it. The only negative you're going to give me, and I'm assuming this podcast is for agents, not members, though if members hear it, here's the big shebang. Here's the only negative you're going to give me. You can't flip that business every 6 years. It's the only negative you can give me. Because a lot of agents like to come in and flip that business so they get paid full comp again after 6 years. Well, you're not going to be able to. Our persistency on this plan is 97.5%, and that includes people who pass away. So overwhelmingly, the only people that leave this plan is because they pass away.
And that's really the biggest reason why you should be looking at this type of plan is the rate stability that comes with it. Historically,
Absolutely.
now obviously you can't promise anything in the future, and there's going to be rate increases. But because of how the product is structured, the integrity of that rate stability is kind of built into the plan.
Absolutely.
And so let me get this straight. So with the Innovative G, one of two things is going to happen. Either the rider is going to convert to a G, or the member at any time is going to convert to a G. But one of those two events is going to occur in that first 3 years.
Yeah, so technically it's still a Plan G, so you don't convert to a G, but I get what you're saying. You're right. Either your rider drops off and you have a discounted traditional G forever, or you drop the rider before the discount period, and then we move you to a regular Plan G's premium. But if you keep that rider, you keep the discount. Either way, you get a traditional Plan G's benefits at some point in the future. You can't lose, bro. Yeah, you can't lose.
You know, it kind of reminds me of a asset-based long-term care plan. Either you're going to use the benefit or you're going to die. Either way, you're getting a benefit from it.
Yes, absolutely. Except our benefit is going to keep you the most stable.
So when agents think of Physicians Mutual, myself included, I think a lot of agents think of your MedSup product, your dental product, but you guys have a whole suite of supplemental products. What are some of those products that maybe agents should have on their radar and be considering with Physicians Mutual? And I know they're not available in every state, and that's coming, but give us a little bit of a high-level view of the product suite that you guys have.
Sure. So obviously dental and obviously Medigap. We've got a strong a critical illness plan. It's essentially a cancer, heart attack, stroke plan. The reason I think it's so strong is because if it pays out its benefit, there is no reset period to pay out again 100% benefit for a diagnosis. So to give you an example, let's say you go in with a breast cancer, and you go in the hospital, and one of the benefits pays $300 a day you're in the hospital, right? So if you go back in a year later with another cancer diagnosis, some cancer plans, and a lot of them, they'll only pay a percentage rather than the full 100% for the first year after a cancer diagnosis, second, third. You get what I'm saying. We continue paying 100% on that benefit. Doesn't matter how many times you go or how often you've gone. So that doesn't reset, or that resets, excuse me, which is really cool. And we've also got the cheapest guaranteed issue life final expense rates that I've ever seen. I mean, cheaper than Legacy, and Mutual Amount Legacy is real cheap. But
I wasn't even aware that was available.
Sure enough. we've got a new policy coming. It's a perm term, so it's a whole life. Essentially, it's going to be final expense, but it's whole life with a term rider. Oh, brother, it's going to be fabulous.
Walked out.
Really strong comp, really strong premiums. Some of, if not the cheapest in every zip code, right? It's going to be from 15,000 whole life, and it goes up to 250,000 with a term rider as well. So you're going to see a lot of people sell just the whole life with 15,000 final expense. The term can go as low as 5 years, up to 20 years, depending on the age of the member. And the ages go from 45 to 80. We're talking about you could have a 68-year-old with a 15-year term who's got 15,000 in whole life and 100,000 in term life because they don't have their house paid off yet. I don't know if you know this. Almost like 70% of seniors don't have or still have a mortgage. That's changed over the years. Used to be that mortgages were paid off by the time you got 65, or well over half was. Now about 70% don't have it paid off. So you're able to sit down with someone and help them with their Medicare, MA or Medigap, Part D if you need it with Medigap, dental, ancillary benefits, maybe a hip plan, critical illness if you sold them in high deductible or in MA. And then you can also help them with end-of-life planning, as well as a term rider on top of that, that I'm telling you, some of the strongest premiums out there and really strong commission. You guys are going to like it. Should be a Michigan 7-1. Should be there.
Yeah, I think there's a...
No, 8. Should be in Michigan May 8th. Boom.
Okay.
Sorry.
Bam.
A month and a half from now. The Innovative should be there 7-1. This should be there 5.
Not May 4th. May 4th be with you, or whatever the...
Why? Right past that.
Yeah. So that term product is really fascinating. I think that there's definitely a hole in the marketplace that needed to be filled, and so many people do have liabilities going into Medicare and even into their 70s. And yeah, it's not uncommon to see people refinancing and still having a 15, 20-year mortgage at Medicare time.
Yeah, that's a good word. And it doesn't hurt that our life plan that we're talking about bringing in right now, this perm term plan, it's a blend. It's called the Secure Essentials Plan. It doesn't hurt that this plan is instant issue. So as soon as you write it, you know whether they pass or not.
Oh, very nice.
That's going to be cool. Agents are going to love that.
Now, is that going to be available for phone sales as well, too?
Oh, yeah, it should be available for anyone that has our contract.
Perfect.
Absolutely.
That's awesome.
So, I don't think it's any secret that the Medicare market has been a little volatile lately, if not the past 2 or 3 years. From your perspective, specific maybe more to the Medicare supplement market, but definitely comment on both. What's the current state of the industry, and what are some of the key factors driving the instability in the Medicare supplement market right now?
Yeah, this is my niche.
That's a loaded question.
So,
there's a lot to
I'll
unpack
speak
there.
to
I
both.
get it.
Yeah, I'll speak to both. The main drivers, at least on the Medigap side, obviously you have, well, let me restart with this. This is going to be controversial, but if you understand me, you'll believe me. You don't take a Medicare supplement to pay your Part A deductible. It's not why you take a Medigap. I want you to think about it this way. If you get put in the hospital, and no agents sell on the Part A deductible. It's not how you sell MedSup. If you get put in the hospital, your Part A deductible is $1,700. A little over $1,700, right? $1,767, whatever it is. A little over $1,700. You can pay that with the hospital interest-free over 3 to 4 years. You can set up a monthly payment plan, paying $30, $35, $40 a month, interest-free. Don't even need a credit card with the hospital. That's not why you take a Medigap. So Medigap premiums are not going up because Part A's deductible is going up. Y'all following me so far?
Sure.
Is that controversial? I don't think it's controversial.
Only if you want it to be.
Yeah, right. You sell a Medigap because of Part B. And it's that 20% that Plan G and Plan N covers. That's why you sell a Medigap, right? It's not because of Part B's deductible. You don't buy a MedSup to pay for Part B's deductible because that's not a big expense, not why you pay a premium. You don't even buy a MedSup to pay the excess fees because excess fees are They're a distraction. They're not reality for 98, 99% of doctors out there, right? So you're really buying a Medicare supplement because you're scared of the volatility of that 20% on Part B. And that volatility is what's happening in the Medigap market. So two things are at play. Several things, but two main things I'll talk about. The first is that 20% is through the roof. Medical inflation has doubled in the past 5 years. So since 2021, medical inflation has doubled. And when I say inflation, I'm talking about biologics. I'm talking about infusions. I'm talking about chemotherapy, immunotherapy. I'm talking about any kind of anything billable outpatient to that 20% has doubled, if not more, since 2021, right? Okay. Because of that, the Medicare supplements like Plan G and Plan N have to pay for those things. Since they have to pay for that, they raise the premium. That's the volatility you're buying against or hedging against when you take a Medicare supplement. That's the first thing. And I'm going to say three things. The second thing is fraud. Fraud right now is running rampant, and it's not that bad on MA because MA has a lot of prior authorization levers that they can pull. But on traditional Medicare, it's horrific. We're talking hundreds of billions of dollars in fraud. Hundreds of billions of dollars in fraud. And it's almost exclusively going towards Part B. And it's that 20%. So we're talking primarily durable medical equipment. There's bad actors out there and foreign actors, both of them, that are billing for outpatient rehab. They're billing for catheters. They're billing for DME shoes, like sole inserts for diabetics if they've never been diagnosed with diabetes. All kinds of horrific things. And because of those billions with a B, it's causing Medicare, this is a little ridiculous. CMS has this idea that they will pay and then audit, which is backwards, right? They pay and then they audit. So there's a group right now, Sunshine Health Services. You can look them up because these cowards, we've got an internal team. The internal team is a fraud team starting May of 23. They found $12 million in fraud that we would have paid out. That's our 20% that Medicare approved and paid. If our 20% is 12 million, that means Medicare's 80% is what? I don't know, 6 times 8, 48 million, something like that. So Medicare paid these guys 48 million, and we're only the 11th largest Medigap carrier in the nation, which we're not in all states. That's still kind of cool, but we found 12 that Medicare paid 48 million on. And a lot was to these Sunshine people. If you Google them today, they're still open. So it doesn't matter how much fraud you found, the game is this. You close your DME shop when it gets too hot, when the heat is on too high, and you open up a new LLC, DBA under some other name, and you keep doing the same thing. Thankfully, the Oz administration just came in, if y'all just saw this. They're putting a moratorium for 6 months on durable medical equipment. Have y'all seen this in the news? And agents are freaking out, and they're not freaking out over the right thing. They're freaking out because they think what's happening is they're not allowing durable medical equipment to be paid for over the next 6 months. That's not correct. What they're doing is putting a moratorium on new durable medical equipment providers coming into the market over the next 6-month period. So that when the bad actors leave, they can't just open up new shop under another name with a different tax ID or EIN number and start fraudulently billing again. So this is a great thing, I think. I think it's a great thing. So that's going to cut down a lot of fraud. But fraud's my number 2. Here's my number 3. There's an actuarial strategy called a charter rotation strategy. Y'all ever heard this language before, charter rotation strategy? All right, let me explain how it works.
Oh, yes, obviously. I think I know where you're going with this.
Yeah, essentially, and it was coined by, really, I would say Mutual of Omaha coined it. And it worked for decades, right? It's just not working anymore. So the way the way a charter rotation strategy works is this. The idea behind it, right? The idea behind it. You open a block of business or a pool of business, and hopefully my listeners understand that. What I mean is you give people the ability to purchase your Medicare supplement, all right? You keep that block open for 4 years. You close the block. While it's open, you take lower than standard rate increases. You also come in with a Plan G or Plan N that's anywhere from 30 to 50% cheaper than United Healthcare. Now, I use United Healthcare because they're the #1 Medigap per life carried plan carrier in the nation. They have more lives on their Medigap and MA than any other carrier. So I'm going to use them as the standard, right? So you come in with what the carrier that has the most lives on their block of business offers as a premium, and you undercut that premium 35, 40, 50%, right? For 4 years, you get as much of the T65 market as you can. And really, T65 to T68, anyone new to Medicare. That's 70 and older, it's a little different story, but just follow with me right now. You close that block after 4 years. When that closes, you open a new charter underwriter that still has the same parent company, but because it's a new underwritten charter underwriter, you can artificially relower premiums and open a new block of business to get to become healthy again. The problem is that closed block of business now has to take significantly higher increases to offset the losses they have from having a premium that's introductory and not reality. In a charter rotation strategy like this, the average amount of time it takes to become profitable is 16 years. That means you have to have that block for 16 years before you start seeing a profit. And let me tell you, it worked for a while. Then 2020 came, and everyone got COVID, and everyone's going to the doctor or hospital. And do y'all remember the government was paying every bill if you had COVID? They were just covering it all. Insurance companies weren't going to pay nothing. In fact, MA companies were so stressed because they have to spend 85 cents on every dollar, 85% medical loss ratios, on medical benefits, that they had to start just creating things to spend money on. Cigna came out with a robot dog. Do y'all remember the robot dog?
I thought that was WellCare, but maybe it's both of them.
Maybe it was WellCare. I was thinking, whoever it is. One of them came out with a robot dog, and then that's when HRAs, they started paying you $250 for an HRA. And then they Aetna came out with paying your golf clubs and your golf shoes and your snow skis, all these things. They were trying to find ways to spend that 85% medical loss ratio, because if they didn't, they had to give it back to the federal government. They didn't want to do that, right? So MA, unfortunately for Medicare Advantage, they couldn't just open a new fund and put that money in the fund to use for a rainy day. They had to spend it on something. On Medigap, I still have questions about carriers who were taking 8 to 15% increases during COVID when they really weren't spending that much money, but that's beyond my pay grade for some of these carriers out there, so I'll back out of that statement. Anyways, so 2020, 2021, maybe into 2022, it was a gold mine. It was a gold rush, right? It was a gold rush. I think we might probably know some of the same people who MA carriers were striking them checks for $250,000, $300,000 for pushing their MA. I'm going somewhere else. Never mind. I'm sorry. So let me get back into this. 2023 hits.
You're not wrong.
And all of a sudden, yeah, I'm not wrong. All of a sudden, all the people who didn't get their preventive checkup done in 2020, 21, or 22, now we're going in to get their AWV or going in to get preventive checkups, and they're getting diagnosed with stage 4 colon cancer. They're getting diagnosed with diabetes, and their A1C levels through the roof, and they're sick. They're getting diagnosed with, you get the idea, anything. That they didn't go check these things up during COVID because either they were scared to leave the house or they couldn't get in to see their primary care physician or specialist. And now their morbidity is through the roof. And they're depressed, and they're sad, and they're eating themselves to death, and they're getting diagnosed of all these things. And now all of a sudden medical loss ratios that you have to at least have a minimum of 65% on an individual Medigap, 75% on group Medigap, and the same with MA, 85% on MA, are starting to go through the roof. So for those who don't know, if you're listening to me, a medical loss ratio is just a math formula. It's how much premium are you bringing in divided by how much do your claims do you pay out. If you're 100% medical loss ratio, that means if you bring in $100 in premium, you spend $100 in claims. This is before you pay your agent's commission. This is before you pay to rent or lease your fax machines, if you still got them, your printer, your copiers, before you pay underwriters. This is just claims, right? We started seeing, for the first time since the early 90s, Plan Gs running at 150% medical loss ratios, and they're 3 or 4 years in the market. I saw one in Utah the other day I looked up. Their medical loss ratio was over 600%. That means for every $100 they brought in profit, they were spending $600 in claims. Now, you don't have to be an MBA, or you don't have to have your doctorate in economics to understand, if you're paying out more in claims than you're bringing in profit, you're not going to be sustainable very long. What did we see then? We saw some of the largest carriers. We saw Allstate, Manhattan Life, Federal Health and Life, American Home and Health. We saw Humana Achieve in a lot of states. UHICA start pulling out, if not all states, pulling out of a lot of states, right? Because those states, they were no longer profitable for this rotation strategy that they had brought in.